Welcome back to the Deep Dive. Today we're diving deep into personal finance, specifically smart borrowing and strategic financial management.
Ooh, sounds interesting.
Yeah, and trust me, this source material, some of it's pretty surprising. Get ready to rethink what you thought you knew about debt and investing.
Okay, I'm ready. Let's do it.
Okay, so one of the things that really stood out to me was this idea that not all debt is created equal.
Right?
Have you ever heard that before? Good debt, bad debt.
Absolutely. That's a key concept. And I love how these sources kind of reframe debt, as a tool,
Yeah.
like a tool to build assets that are going to appreciate over time.
So it's not always a bad thing.
Exactly. It can actually be, a calculated risk that leads to more wealth.
So give me an example of what you mean.
Sure, sure. So think about a mortgage.
Okay.
Right. You're taking on debt, but you're buying a property that's likely to increase in value.
Great.
That could be considered, good debt, quote unquote.
I like that. I like that. So that's good debt. What would be an example of bad debt?
Well, bad debt is basically, borrowing money for things that lose value quickly or don't generate future income.
So like that new iPhone.
Yeah,
Gotta have.
the latest gadget, you're stuck with that debt and
Yeah.
the gadget's not so shiny and new anymore.
Right. Exactly. Exactly. So it's really about being strategic with your debt.
Yes, leveraging it to your advantage, not letting it weigh you down.
And speaking of leverage, our sources talk a lot about, understanding the different types of debt tools that are out there.
Yeah, they break it down. You got your mortgages, credit cards, personal loans, even student loans. And they really get into, the characteristics of each one, the interest rates, the repayment terms, are there tax implications?
Oh, okay.
All of these things that impact your financial health big time.
So it's really about, it sounds like it's really about picking the right tool from the toolbox, depending on what it is you're trying to do.
Absolutely. It's not one size fits all at all. You wouldn't use a hammer to tighten a screw, would you?
No,
No, you wouldn't.
exactly, exactly. Now, one of the things that I thought was kind of interesting was this idea of using, and maybe a little controversial, this idea of using credit cards strategically for daily expenses, but to free up cash for investments.
Right. Yeah, it's a bold strategy for sure. It requires discipline.
Yeah.
The source really makes that clear. You got to be able to repay that balance in full every month. Otherwise, forget it.
Right, or else you're just racking up all this interest.
Exactly. Exactly. But the idea, if you can pull it off, is that you could potentially be earning more from your investments than you're paying in interest.
Okay, so give me an example.
Sure, sure. Let's say you put your grocery bill on your credit card.
Yeah.
Instead of paying cash, you take that cash, you put it into a short-term investment, something with a guaranteed return, like a bond or a CD. And if that return is higher than your credit card interest rate, boom, you're making money.
Okay, I like that. So you're basically sort of playing the system a little bit.
You could say that, but again, high level of financial discipline needed here.
But, I can see how easily that could backfire if you're not
yeah,
careful.
Right.
If you overspend, you're not repaying those balances on time.
Yeah.
You could wipe out any of those gains, right?
Absolutely. You
Yeah.
need to be on top of your budget. You need to understand your spending habits, before you even think about trying something like this.
Yeah, absolutely. Absolutely.
Mm.
And the source also talks about, situations where debt should be avoided altogether.
Oh, yeah. Like they're very clear. Don't use debt to finance a lifestyle you can't afford.
Right, right.
You want those luxury purchases, the fancy vacations, designer clothes. Save up for them. Don't put them on credit.
They have a really good example about buying that new iPhone
Oh, right.
on an interest-free installment plan.
Yeah. Seems like a good deal, right?
Yeah, you think so. But
But when you look at the opportunity cost, what you could have done with that money if you invested it,
right.
the true cost of that phone is way higher.
Right, exactly, exactly. So they really emphasize this idea of borrowing within your means.
It's crucial. So many people, they can make the monthly payments, but are they really sustainable? Are you sacrificing other financial goals? Like, are you not saving for retirement or a down payment on a house?
Mm-hmm. Interesting. Interesting. Well, they give a really good method for determining, what a healthy debt level is, and that's calculating your debt-to-income ratio.
Right. It's all about subtracting your essential expenses plus your planned savings from your income. What's left? That's what you can realistically put toward debt.
So it's like a little formula.
It is, and it helps you avoid that dangerous debt spiral. When you're borrowing to pay off old debts, it's a trap.
So are there any examples from our source material about that debt spiral?
Oh, yeah. They tell the story of Jack, a listener who wrote in. He was making good money, but was always struggling, drowning in credit card debt.
It's like robbing Peter to pay Paul.
Exactly. Using one card to pay off another. And those interest charges, oof, they just pile up.
Yeah, it's scary. It's scary.
It's a good reminder to get your spending under control, make a realistic plan to pay down that debt.
And that actually leads us perfectly to our second big theme from our sources, strategic financial management.
Yes, it's not just about getting out of debt, it's about being proactive, managing your money so you can reach those long-term goals.
So it's like having a plan.
Exactly. A roadmap to get where you want to go.
So it's not just about chasing those returns, it's about allocating your money to be prepared for life, for things that are going to come up in life, right?
It is. And it's also about, tying it back to what we talked about with debt. Smart borrowing can be part of that plan.
It all fits together.
It all fits together.
I like that. Now, to help understand this approach, the sources talk about something called the impossible triangle of financial planning.
Ah, yes. The impossible triangle. Have you ever heard of it?
I have. It's this idea that there are three key things when it comes to financial tools. You've got safety, return, and liquidity.
And you can usually only pick two.
You can't have all three.
It's a trade-off.
Wow.
Always.
Yeah.
So you got to prioritize. Is safety most important, even if it means lower returns? Or are you willing to take more risk for the chance of bigger gains? And how important is it to be able to get to your money quickly?
Yeah.
Tough choices.
So it's like trying to juggle three balls, but you can only keep two in the air at the same time.
Huh. I like that visual.
Very true.
So, if you go for high returns and liquidity, you're probably going to have to accept more risk.
So give me an example.
Sure. Think about a high-risk stock.
Okay.
Could have amazing returns, and you can usually sell it pretty quickly.
Mm-hmm.
But you could also lose a lot. A savings account. Super safe. Easy to access. But the returns, not so exciting.
Okay.
See? Trade-offs.
I see. Yeah. Well, they have a three-step method for choosing the right financial tools based on those three factors. What do you remember about that?
All right. So step one is, when do you need this money? What's the timing of the event you're saving for? Is it next year or is it 30 years from now? That tells you how liquid it needs to be.
Okay.
You wouldn't put your emergency fund, something you might need right away, into a long-term investment, right?
Right. Okay. So step two.
All right. So step two is how much risk can you handle, for this particular goal? Are you playing it safe or are you feeling lucky? It's all about your risk tolerance.
Mm-hmm.
And that can vary. What you're comfortable with for a honeymoon fund might be different from what you'd choose for a down payment on a house.
Okay. That makes sense. And step three.
All right. The final step. How much money can you actually invest? Your principal. And this is where smart budgeting comes in.
Mm-hmm.
And debt management. Free up that cash. The more you have, the more you can potentially grow.
It's like planning a road trip. You got to know where you're going, how much time you have to get there, and how much gas is in the tank.
Huh. Perfect analogy.
I like that. Now, this three-step method, it sounds simple, but it's really forcing you to think about, what are your goals and how are you going to get there?
Exactly. It's powerful stuff.
And they actually use an example of a couple planning their honeymoon to kind of illustrate how this works.
Oh, right.
So let's say they want to go in 3 years, and they're okay with taking on a little bit of risk to hopefully get bigger returns.
Okay.
So they need a medium-term investment, something with good growth potential.
All right. So they can rule out those low-yield savings accounts. And those super long-term investments, they can't touch for years.
Right. Exactly.
So maybe they look at a diversified mutual fund or a portfolio of stocks that matches their risk tolerance and time frame.
Now, that's getting into specific investment vehicles, which I think we're going to talk about in our next deep dive.
Sounds good to me.
Yeah, me too. So before we jump into, all those specific ways to invest, the sources, they talk about some common pitfalls people can fall into, even when they're, trying to follow that three-step method we just talked about.
Right. I think one of the big ones is what they call mismatched time frames. It's easy to do. You're investing for a long-term goal, like, retirement.
Mm-hmm.
But then something comes up and you need that money way sooner than you planned.
It's like you packed for a weekend trip and you only brought, fancy gowns.
Yeah.
Not exactly what you need, right?
Right.
The source gave an example, like having your emergency fund locked up in some investment that you can't touch without getting penalized.
Yeah. And then boom, unexpected car repair. What do you do?
Right. Exactly. Exactly. So it really comes down to matching your investment to the goal, right?
Exactly. How soon do you need this money? Short-term goals, you need something easy to access. Long-term goals, you have more flexibility.
So you can take on more risk, potentially.
Exactly. Exactly. They also talk about mismatched risk, which is, well, it's kind of what it sounds like.
Okay.
The risk level of your investment doesn't fit the goal.
So, like, don't put money you need next year into something super risky.
Right, like your kid's college fund. You don't want to gamble with that.
Right. Like betting your rent money at the racetrack.
Yeah.
Maybe you'll win big, but
Yeah, maybe not.
not a good idea. Not a good idea. And the third pitfall, they call it mismatch principle, which basically means, do you even have enough money to invest?
Right, without going into debt.
Because that's the other thing they warn about. Don't borrow money to invest.
Too risky. Could lead to a whole mess of debt.
So it's like you're building a house on a shaky foundation.
Exactly. Invest what you can afford to lose. And build that foundation first, saving, managing debt responsibly, get that right.
So now, let's switch gears a little bit and talk about some specific ways to invest your money. The sources, they go through a whole range of things, from basic savings accounts to stocks and bonds.
And they break it down really well, the pros and cons of each option, so
Sure.
you can figure out what's right for you, what's your risk tolerance, what are your goals.
So they're really giving people the tools to make informed decisions.
They are. So, for example, they point out that savings accounts, super safe, easy to get your money out,
Hmm.
but the returns, pretty low. You're
Mm.
basically just keeping up with inflation.
So you're not really growing your money.
Not really. Now, stocks, on the other hand, potentially much higher returns,
Hmm.
but much higher risk too.
The source compared it to riding a roller coaster.
Yeah.
Up and down, up and down.
So you got to have a strong stomach.
You got to be okay with those ups and downs.
Right. And they also talk a lot about diversification.
Ah, yes.
Don't put all your eggs in one basket,
No.
right? Spread your investments around different asset classes to minimize that risk.
So what would a well-diversified portfolio look like?
Well, it could include stocks, bonds, real estate, maybe even some alternative investments like commodities or precious metals.
Oh.
It depends, really, your individual circumstances. Risk tolerance, time frame, financial goals. It's not one size fits all.
So it sounds like getting advice from a financial advisor is a good idea.
Yeah, it can be super helpful. Get a personalized plan, something that really works for you.
And I think that's a good takeaway. I mean, it's not just about picking the right investments, it's about managing those investments.
Right.
Absolutely. Staying on top of things, making sure your portfolio is still balanced the way you want it, keeping up with what's happening in the market, being ready to adjust as needed.
And the source really stresses that this is a long game.
It is. It is.
Uh-huh.
It's not about getting rich quick. It's about patience, consistency, building wealth over time. It's like planting a tree. You got to nurture it, give it the right conditions to grow.
And speaking of nurturing, let's talk about managing your money effectively.
Okay, so the sources, they really hammer this home. You got to have a budget. You got to track your spending.
Because you'd be surprised how much money just sort of disappears.
Right. Like a leaky faucet, a few drops here and there, but it adds up.
Yeah. So once you know where your money's going, then you can figure out, okay, where can I cut back? Where can I save more?
Exactly. And they give some good tips, pack your lunch instead of eating out, negotiate better rates for your phone or internet, get rid of subscriptions you don't really use.
Those are all good tips, good practical tips.
And they also talk about automating your savings.
Ah, yes. Pay yourself first.
Exactly. Set it up so it just happens automatically every month. Money goes straight into your savings account. You don't even have to think about it.
It's like setting your alarm clock, right?
It is. You don't have to rely on willpower to wake up. The alarm does it for you. And speaking of setting yourself up for success, let's talk about financial education. This is something they emphasize a lot, right?
Yeah, they're big on it. Being proactive. Learn about personal finance, read books, listen to podcasts, take online courses. There's so much information out there.
And it's not just for adults either, right?
Right. Teach your kids about money. The earlier, the better.
Budgeting, saving, spending wisely.
Yeah, it's like learning to ride a bike. The more you practice, the better you get.
So you're giving them a good foundation.
Exactly. And speaking of foundations, let's talk about setting financial goals. Do you find that people struggle with this?
I think a lot of people do.
Yeah.
They have this vague idea of what they want, but they haven't really taken the time to write it down, make a plan,
Right. It's like going on a road trip with no map. You might get there eventually, but
but you're going to take a lot of detours.
exactly. So having those goals, it keeps you motivated,
Hmm.
helps you track your progress.
And make adjustments along the way if you need to.
Exactly, exactly. And they also say, start small. Don't try to do everything at once.
Little steps.
Yeah, break those big goals down into smaller ones. It's like climbing a mountain. You focus on getting to that next base camp.
And you celebrate those wins along the way.
Yes, every little victory.
Yeah.
Maybe you paid off a credit card or saved up for a down payment on a car. Whatever it is, celebrate it.
I like that. Keeps you motivated.
It does. And at the end of the day, the sources remind us that this is a journey. It's not about reaching some finish line.
It's about the process. Making good choices, building those good habits, always trying to improve your financial situation.
And like any journey, it's better when you have the right tools and the right people supporting you.
And speaking of support, they talk a lot about the power of community, right?
Yes. Don't be afraid to talk about money with your family, your friends. Get advice from professionals. Learn from each other's experiences.
Because we're all in this together.
We are, and sharing that knowledge, it can empower all of us to make better decisions.
Create a more secure future for ourselves, for our families. Okay, so let's shift gears a little bit and dive into how to actually align your money with those big life events that we all go through. Welcome back to the deep dive.
Yeah.
So we're talking about, how important it is to have that support system when it comes to finances, right? But now let's get into the nitty-gritty of aligning your money with those big life events, the milestones that can really impact your finances.
Yeah, the sources break it down really well, actually. It's like they've created this financial roadmap for you.
I like that, a roadmap. And those big life events, they're like the destinations along the way.
Exactly. And they cover it all.
Yeah.
Marriage, buying a house, having kids, planning for their education, and of course, retirement.
The biggies, yeah.
And what's so helpful is they emphasize that each one needs a different financial approach.
So it's not like, okay, here's your one financial plan and you can use it for everything.
No, not at all. You wouldn't use the same plan for, say, your wedding as you would for saving for retirement, right?
Right, right. Makes sense. So they actually suggest having different buckets or accounts for each event.
Yeah, to keep things organized, make sure you're allocating your money the right way. It's like packing for a trip, right? You wouldn't just cram everything into one giant suitcase.
I like that analogy. Separate bags for different purposes.
Yeah.
Okay, so let's unpack some of these life events, starting with getting married. What are some of the things couples should be thinking about financially?
Well, the sources really stress communication.
Okay.
Being open and honest about money from the beginning. What are your goals? What are your spending habits like? Any debt you're bringing into the marriage.
It's like laying it all out on the table.
Exactly. Because, let's be real, money can be a huge source of conflict in relationships. They also talk about setting a realistic budget for the wedding itself.
Ah, yes, the wedding can be a big expense.
It can be, and they're very clear. Don't go into debt for a fancy wedding. Remember all that talk about bad debt? Starting your marriage with a ton of debt is not a great idea.
Not the best way to start. Yeah, no, I agree.
Yeah.
So they're really encouraging couples to think long-term, beyond the wedding day.
Exactly. What about furnishing a new home, buying a car, maybe a honeymoon? All those things add up. And then there are the legal and financial aspects of marriage, too. Prenuptial agreements, how you'll manage your money as a couple, joint accounts, separate accounts.
It's a lot to consider.
It is, but it's important to figure out a system that works for both of you, so you're both on the same page, comfortable with the decisions you're making.
Okay, so let's move on to another big one. Buying a house.
Eh.
That's a huge financial step for a lot of people. It can be kind of scary, actually.
It can be, but the sources break it down, make it seem less overwhelming. First step, figure out what you can actually afford.
Okay.
And they remind you, it's not just the mortgage payment. You got to think about property taxes, insurance, maintenance costs, all of that adds up.
Right. It's easy to forget about those extra costs.
It is. They also say, save as much as you can for a down payment. The more you put down, the lower your monthly payments.
So it's worth it to save up.
Definitely. And of course, location. Think about the neighborhood, the commute, how all of that will affect your finances.
And one thing they suggest is, before you even start looking at houses, get pre-approved for a mortgage.
Ah, that's a smart move. So you know exactly how much you can borrow. And when you find that perfect house, you're ready to go.
Makes the process smoother.
It does. All right, so another life-changing event, Having kids.
Yeah, kids. They're wonderful, but they can definitely impact your finances. Diapers, daycare, and then down the road, college tuition. It adds up quickly.
It does, it does. The sources, they're big on starting early with college savings. The sooner the better.
Let that compound interest work its magic, right?
Exactly. They talk about 529 plans, which can be really beneficial. And of course, they also emphasize teaching your kids about money.
Start them young.
Yeah. Budgeting, saving, spending wisely. Make it a family affair. Talk to them about how you're saving for their education.
So it's not some big mystery.
Right. It's just part of life.
Yeah.
And speaking of long-term planning, we got to talk about retirement.
Retirement. For some people, it might seem far off, but the sources really encourage people to start thinking about it early.
The sooner the better. They suggest, working backward from your ideal retirement age. How much money do you want to have? How much do you need to save to get there? Gives you a clear goal to aim for.
Makes it feel more manageable, I guess. Less overwhelming.
It does. It does. And they also talk about diversifying your retirement portfolio, thinking about your risk tolerance, your time horizon, and of course, taxes.
There are a lot of factors to consider.
There are. They also discuss different retirement savings options like 401ks and IRAs, and they really emphasize take advantage of employer matching contributions if you can. Free money. But it's not all about the numbers, right? They remind us that retirement is about living a good life.
Enjoying the fruits of your labor.
Exactly. Travel, hobbies, spending time with loved ones. But to do all that, you need a solid financial foundation.
So it's all connected. Well, we've covered a lot of ground today, from smart borrowing to planning for those big life events. What are your main takeaways from all of this?
For me, it's really the big picture. Financial well-being, it's a journey. It's about making smart choices, building good habits. It's a process.
And it's a process that's easier when you have the right information and tools and a good support system.
Absolutely. And I think these sources, they've given our listeners all of that. They've made these complex financial concepts, more understandable, given practical advice. And most importantly, I think they've given people a sense of control, like they can actually do this.
Empowerment, yeah. So to our listeners out there, take what you've learned today. Start setting those financial goals, create a budget, start exploring those different investment options.
And remember, you don't have to go it alone. Talk to a financial advisor, do your research, connect with other people who are on this journey too. We're all in this together, right?
Exactly. And we want to hear from you. What are your financial goals, your challenges? What's worked for you? Share your experiences in the comments. Let's keep this conversation going.
Because the more we share, the more we all learn.
And the better off we'll all be. Thanks for joining us on The Deep Dive. We'll be back next week with another deep dive into a new topic. Until then, keep learning and keep diving deep.